Gold prices were near 1.2 to 1.3 lakh rupees per 10 grams for 24 carat. Silver was hovering roughly at around 1.8 to about 2 lakh rupees per kilogram. The break for silver actually started way back in July 2024. Is gold still a good investment? Gold prices were near 1.2 to 1.3 lakh rupees per 10 grams for 24 carat. And silver was hovering roughly at around 1.8 to about 2 lakh rupees per kilogram over the Dhanteras weekend. And if we tracked a few weeks back to October 8th, we saw gold actually hitting a fresh all-time high, and that was its 45th record breaking high of this year. That is a leap of nearly, in that 36-day period that we saw back in September, we saw it rise by about 15% in a single month. And during that period, what we saw was that silver was also rising fast. So if you bought gold or silver this Dhanteras or in the past few weeks, have you caught something that is trending, or do you think it's a trap? That's what we'll look at today. We'll cover what is happening to gold rates in 2025, what's actually driving the silver prices in India specifically, how foreign exchange rates can actually have an impact on the gold and silver price rise in India. We'll also look at what RBI is doing with its war chest in terms of the gold that it's accumulated. And finally, we'll also look at, is gold still a good investment post Dhanteras, post Diwali? So in September, gold hit a new high. It rose nearly 15% in a span of 36 days. And this says less about the fair value of gold, but more about the concentration of demand that has happened specifically during the festive season. Like we mentioned earlier, there have been 45 new record highs that have been set for gold prices this year, and the overall gold bull phase is currently in a 735-day-old period. Historically, if you look at the chart, what you see is typically large gold runs or large gold phases, bull phases, have typically stretched beyond about 1062 days. When you look at the trough to the peak. Time-wise, if you look at it, 735 versus 1000 plus days, it's not been unusually long as of now, at least. What's specifically behind this gold rally is a mixture of things. One is that there is a demand which is leaning towards investments. We've seen ETFs, coins, bars doing the heavy lifting. There's also jewellery which was sort of supportive but not necessarily the core driver. When we look at physically backed ETFs globally, what we've seen is that roughly nearly 630 tons of gold has been added by early October, and that sort of takes the total holdings to roughly around 3,857 tons. Now that is still below November 2020's peak. And futures positioning is also showing that there is froth typically seen at the past highs. Participation has been expanding, but are we really at the full saturation? Not really. Now the specific why has to do with, one, the geopolitical risk that is there, and that's refusing to sort of go away. The trade tariffs, the geopolitical tensions that are there, so on and so forth. The second is that the dollar has also softened, specifically against many of its major peers and trading partners. Third is that there is also an expectation that the Fed will cut from its restrictive levels. And fourth is that there is somewhat of an unease among many investors related to stocks, bonds, maybe high valuations, etc. So when we look at real policy rates, and if they'll sort of drift downwards, gold's relationship with that sort of real yield curve typically brightens, it becomes better. And investors who believe that these real yields will sort of slip up are paying for these high duration sensitive assets essentially. And if you were to compare gold's rally currently to what has happened in the 1979, which was a phenomenal gold rally period, it might seem very similar, but overall the macros are different. Today we are seeing much higher real rates, which are also trending downwards. The US has a very fragile job market currently. Credit spreads are quite tight compared to what we've seen historically, and are also much longer than usual in this sort of late in a cycle. Investors base is also quite broad. We're seeing many more investors who've entered the market and are investing. Typically what we've seen is, let's say there have been 2 long ETF accumulation waves since 2003, where we've seen roughly 2,000 tons of gold being added over a 4 to 5 year period each. So there is a fresh accumulation phase that is sort of kicked around roughly May of 2024. and like we said earlier, this is around 74 weeks old. And if you look at the historical data in the graph, what you'll see is that there is still a lot of room for more tons to be added to the gold tally. Shifting on to silver, what we see is that the break for silver actually started way back in July of 2024. This is when the Indian government specifically cut import duties on silver, on gold as well, from 15% to 6%, which means the landed rates also sort of fell roughly 67% on the first day itself. Now, there were obviously bargain hunters that sort of stepped in throughout August, and within that sort of 3-month period post the cuts, domestic silver had already reached a record high of roughly 1 lakh rupees per kg in the Diwali of 2024. The duty cut that happened, there was a dip, there was a record, this sort of loop produced a very strong retail rally that hadn't been seen since 2015, outside the minor spike that we saw in 2022, as you can see in the graph below. Another interesting thing was that silver ETPs were also launched in 2022, and they sort of caught momentum as we moved into quarter 4 of 2024. Obviously, the inflows have also increased, which is nearly representing roughly around 40% of the overall physical investment in 2024. What this meant is that many equity investors also had a new way or a new path to invest in silver without actually storing it, and that's why we saw silver gain the sort of year-on-year gains of about 81% compared to gold's roughly 39% during this festive season. The real reason, however, is also to do with that silver is in a supply-demand mismatch. What we have is a scenario where there's a significant amount of demand, which is tracking roughly 1.2 billion ounces of silver is needed globally, and when we talk about the supply, that's sitting at roughly 1.05 billion ounces. So that leaves a deficit of nearly 150 million ounces, which is still smaller than what we have seen in last year by about 19%, but it's still a huge amount of demand that needs to be sort of met. And the reason for this demand shortfall is that there is a structural change that's happening. Silver is being more and more required in industrial specifically. Industrial demand is expected to reach nearly 700 million ounces for the first time this year. Typically, this is being led by renewables. We're seeing solar, where there have been record PV installations, and silver is a key component. We're also seeing it in EVs, auto electrics, where silver is being added on a per vehicle basis. There's also in consumer electronics. It's even in AI driven technologies that are coming up, and many more such use cases for silver's demand. Now, final, a very important amplifier when we look at silver and gold rates specifically in India is the rupee. When the rupee is soft, what we feel is the rally typically becomes stronger in India, because the domestic price is basically what we're seeing in the global gold price in the dollar amount multiplied by the exchange rate, along with any taxes and premiums that are there. Now, if the rupee is weaker, so if there is a higher USD INR, what that means is mechanically that lifts the rupee price even higher, even if the international dollar rate hasn't changed. So as an example, let's say if the dollar gold rate is flat, but if the rupee weakens by about 2%, domestically the gold price should also rise by about 2%, everything else being equal. However, now let's say if the dollar rate or the dollar gold rate goes up by about 3% and the rupee also weakens by about 2%, then the domestic gold price should also be up by about 5%. So typically this is why we feel rallies in India for these commodities are significantly more, because what we're seeing is the global move that's happening in this interconnectedness of currency exchange rates, along with any weakness that the rupee might have, specifically when we reach the festive time when premiums are also sort of getting added on. Finally, what we look at is RBI's watch list. So it has crossed 100 billion for as the gold bullion has boomed, and this is for the first time. This hasn't been necessarily from RBI adding on more gold. It's rather more a valuation of the gold has increased. As of the week of October 10th, gold in RBI's books was sitting at about $102 billion and had jumped roughly about $3 billion to $4 billion in that period. Gold's overall share of the reserves has also increased by nearly up to 15%, which is the highest that it's been since over the last 30 years from 1990s. And the more important thing here is that RBI hasn't been buying. It's bought only around 4 tons in the first half of this calendar year, versus the 50 tons that was bought in 2024. Interestingly, however, central banks globally have been net buyers this year, and this has been led by the emerging markets who are trying to diversify away from the dollar given the trade tariff issues. And reportedly, buying has picked up again in late summer of 2025. Specifically for India, a bigger gold buffer typically supports confidence in the overall picture. When oil is elevated, there's a lot of geopolitics that's happening. It also gives RBI a potential option that if they want to rebalance for any price spikes without aggressively dipping into the foreign exchange reserves, they can do so. So is gold a good investment even now? Well, gold's momentum has felt stretched, specifically in the last few weeks. Purely from a technical perspective, gold's RSI, the relative strength index, pushed above the 90s. Price was sitting at about 20% above the 200-day moving average. And this is typically a classic overbought zone where we might see potential mean reversion trades or profit taking happening as well. However, overbought isn't the same as being at the top of the rally. Gold's best friend in 2025 has been this growing perception that policy rates will trend lower from restrictive levels, while the overall growth is also slowing down globally. Markets that believe in this sort of phenomena of falling real rates are willing to pay up that additional amount for the duration sensitive assets like gold, and gold's sensitivity to the overall real yield curve that's there is typically a very clean macro relationship. Now, the higher you climb, the less room there is for this sort of macro disappointment. There are obviously clear positives, which is one is that there are higher real rates that are likely headed down. We have tight credit spreads that could widen. Equity valuations have left a little bit of cushion if earnings disappoint or policy error materializes. Structurally, when we speak about it, if there is a soft dollar and there is a case for strategic gold allocations, even at the elevated levels, that still makes a lot of sense. The caveat, however, here is that each of these 4-5 factors that we've spoken about could reverse. A dollar short squeeze would ultimately stress non-US buyers. If there are wider credit spreads that could force de-risking, that could ultimately hit all liquid winners. If there is a hawkish surprise from the Fed on, let's say, on the inflation, on growth, all of that could ultimately lift real yields as well, and all of this would impact gold's valuation. Point here is that there is not a single risk that is dominating. It is more that the market is exposed to overall path dependency, and the October rally has ultimately reduced the margin for sort of short-term, near-term error. If you like this video, do like, share and subscribe. Let us know in the comments what you want us to cover next. Happy investing and a happy Diwali.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.